So, do any of you have any doubts before I begin solving this set?
Yes, no.
Did anyone say something? Okay, cool. Fine. So let's get started. So like I said before, I'll be doing chapter 8 first, then chapter 14, then 11, then 5 and 6. Okay, so let's get right into this. So the first question, an asset with a fixed investment cost of $40,000. Let's highlight the important stuff. It's depreciated over a 16-year period and it's expected to have a $4,000 salvage value. So what we do for this is, what I do is I write all the numerical values down first. The P is $40,000 and the cycle is, the total periods is 16 years. And the salvage value is $4,000. Right, so chapter 8 basically deals with depreciation of costs and all investment depreciations. So there are 3 methods that they showed us. One is the straight line method. The other one is the declining balance method, and then the units of production depreciation. So this question asks us to use the straight line method. Okay, so for this one, the formula is right here. So yeah, what we do for the straight line depreciation is to calculate the depreciation in every period. So for this method, the depreciation in every single period remains constant. And you can use this formula at the top to calculate it. It is the total, the initial investment minus the salvage value divided by the total number of periods. And then the book value at the end of any particular period can be calculated using this formula. So what we'll be doing here is we need to calculate B9. To do that, first we'll just find the depreciation in any period. So that's 40,000 minus 4,000 divided by someone's unmuted.
You are on mute. I think it's Shalala.
Hmm?
Do you want to mute?
Oh, sorry.
No problem. Okay. So 40,000 minus 4,000 divided by 16. Let me just put this in. 36,000 divided by 16. So it comes out as 2250. This is the depreciation in every single period, and it remains constant because if you're using the straight line method. So now to find out B9, what we do is, 1 second. Yes, so, all right. So the initial investment, 40,000 minus the period, 9, into the depreciation in every period. That's 2,250. And we get that as $19,750. That's basically it. And like this is just putting in the formula. And I guess the first couple of questions are the same way, but I'll just do the first one. Okay, and then what is D6? D6, we can find that out as, oh yeah, it's going to be the same, sorry. Because we're using the straight line method and it's constant. Okay. Now, in using the declining balance method, we find this small d to be 1 divided by n, where n is the number of periods. So 1 divided by 6 would be 1 divided by 6. 0.0625. So that is 6.25%. Okay. Right. So using the declining balance method, right here. Okay. So using this one, it's basically just subbing into the formula. So here, B equals to into 1 minus d raised to the power n. So 1 minus 6.25, which 1 minus 0.0625, which is 0.9375, 40k into 0.9375. And we need to find out E9. Okay. There is to the 9th. So we get this as 22376.9. And the thing about chapter 8 and 14 is we always need to round it off to actual whole number values. So this would be 22377. And that's basically it. And then I'll just solve the third one, and then you guys can ask me if you have any questions. So in the third one, in the double declining method, it's basically the d gets changed to 2 by n instead of 1 by n. And there's a triple declining method too, and in that it's just 3 by n. So in this one, it will be 0.125, which would be 12.5%. Okay, so the formula for b still remains the same. They asked us to find b11 equals to b into 1 minus d raised to the power n, bk into 1 minus 0.125, 0.875 raised to the power of 11. Okay, this comes out to be 9,207.6 I, which is again 9,208. Am I doing this right? Let me just check. Chapter 8, right?
So for the double, so all the declining balance methods are the same, and you just have to multiply by 2, 3, or 1, depending on like which case you're using.
Yeah, exactly. So the only thing that changes is this formula. You're finding the rate. So in the single declining method, it's just 1 by n. In the double declining method, it's 2 by n, and so on.
And do we have to deal with more than like 3 or quadruple or not?
I don't think so, because he just mentioned 3 of them. But I guess it would be the same thing, even if there was such a thing. It would be 4 by n. Yeah, I don't think he would give that.
All right, thank you.
All right. So D9 is just, wait a minute. D into, right, so for this, you just do D into the B of the previous one. So it would be D into B8. So that would be 0.125. And then B is 40,000 into 0.875 raised to the power 8. Because you take the book value of the previous period. So this would come out to be 0.125 into 40,000 into 0.875 raised to the power 8. 1,718. Yeah, that's pretty much it. Right, so this was how we used the first 2 methods that gave us to calculate depreciation. You guys have any questions?
Can I see 2B?
Yeah.
Could you show us 2B? I want to take a look at it again.
Can you say that again?
Could you show us 2B? I want to take a look at something. Like question 2B.
2B. Okay.
Jalla.
1 second, yeah.
Emil,
Sorry.
Yeah, yes, Saket, right? What do you say?
Are you in 1080p stream? Because like I think it's like is it unclear only for me? Like I can't really.
No, it's not. It's just like he can't stream it that high.
Oh, I thought the server is boosted enough so you can switch to 1080p.
You could try.
So the thing is,
you
No,
go.
the thing is, it doesn't allow me to change the quality because like I'm using it on Chrome. It's like I told you, I can't
Oh,
download the app here.
Mm-mm.
So
You won't
the
be
only
able
way
to go 1080 unless you have Nitro. It's fine, Soccer. Just make your screen bigger. Should be fine.
Yeah, okay.
Yeah, it's not
Okay,
that bad. The
cool.
quality is like not that bad.
All right.
Okay, so
Okay,
just a quick
so
thing. How did you know that D6 was the same for 1?
right, for one, so the thing about the straight line method is it's going to be a constant depreciation. The depreciation in each period is going to be the same thing. So
So DN
whatever
is just
period,
always just D, basically.
yeah,
Ah, okay.
Yeah. okay. So yeah, for B, D6 is going to be D into B5. Okay, and this for this one, D was 0.0625, and B was 40,000 into 1 minus 0.0625. That is 0.9375 raised to the power 5. Okay, so into 40k. 0.9375 raised to the power 5. So this comes out to be 1810.49, and I think you just leave it at 1810. Let me check if I got the answer key. Is this the answer key? Yeah, it is. Yeah, so he just leaves it at 1810.49. Okay, so this is how you do the D6. Whoever was asking that. So do you guys have any other doubt in this? Okay.
So for the declining balance methods, the next B is just the previous B times D. Yeah.
The next D is the rate, the small d, times the previous book value.
Because it's kind of
The book value has a specific formula.
yeah. And
If you're talking about the depreciation in any period, that is calculated on the basis of the previous book value.
yeah, and you just like the declining balance method is just the one where like you have to multiply by a factor every year, right? It's correct. It's
Yeah.
that, or you say multiply by 10 or
Yeah.
whatever. Like
Yeah. You just keep on multiplying by a factor, but in this straight line method, it's just constant overall. Okay. So the fourth one. So in this one, they're asking is you purchase an industrial printer for 40,000, and you keep it for 16 years and resell it. Salvage value is 4,000. Okay. The projected total output is 1.4 million pages. So this one we use the unit of production method, and for the unit of production method, this is the formula that they gave us. DN would be service units consumed for the given year divided by the total number of service units multiplied by P minus S. In this case, they said that the total number of pages that can be printed is 1. Sorry? Someone saying something?
Accident on mute.
Okay, cool.
Go ahead.
And this is the total number of pages you can print. And during the 4th year, you print 96,000 pages. For the 4th year, you print 96,000 pages. Okay, so now to find out D4, you just do 96,000 divided by 1.4 million. That is 1. Yeah, I think that's right. Okay, and then P minus S. P is the initial investment minus the salvage value. Okay, so when we put this, let me just cut the zeros. 96 divided by 1400 into 36,000. So we get 2468.57, which I think is rounded off to 2469. This is the answer. Yeah, this is the answer. So yeah, this is how you use the units of production method. It's pretty simple, just putting in the formula. Does anyone have any questions for this one? No? Okay. Right. So let's move to this next one, which is like a group of questions. Okay. In this one, consider an equipment which is of 70,000 today at N0, which will be available for use in its second year. And it's set to be operational for 12 years from today. And then in under 7 years from today at N7, will require an overhaul costing 12,000. CCA rate for the equipment is 30,000, and the overhaul requires a straight line approach. So for calculating the CCA for the overhaul, we'll use the straight line approach, but for the equipment itself, we'll use a declining balance method. Okay, and assume zero salvage value for the overhaul. Okay, 50% rule. All right, I'll talk about this rule. So the thing that we do for these type of questions is you make this table where you write the N, the CCA for the equipment, then the UCC, that is the cost for the equipment, then you make another columns for the overhaul, because the overhaul is treated as a completely new machine. Okay. Right. So they said that you're purchasing the equipment at n equals to 0, but it'll start being available for use in its second year. The thing about CCA is you can only start depreciating the machine when it begins being available for use. We can't start it in the n equals to 0 period. So we start from n equals to 2 and then just keep going. It's for 12 years. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Yeah, I think that should be it. Yeah. Right. So the way you calculate CCA is you just multiply the initial purchase cost with the rate. Okay, so for the first one, it would be 70,000 into 0.3. But here they told us to apply the 50% rule. So what the 50% rule does is that in the first period, instead of taking it at 0.3, take it as 0. We take a half of the rate, 0.15. Okay, so just plugging this into my calculator, you get 10,500 as the CCA cost in the first year. All right, then you just go column wise. Okay, so in the second year, it's gonna be CCA is calculated as the D, right? So the D was based on the rate, which we'll just say CCA rate, and the book value of the previous period. Okay. So here, the book value would be the UCC. Okay. So the CCA rate in the second period, would be the 30%. So 0.3, and then the UCC which was, okay, so for the UCC, what we do is 70,000. And since 0.15% gets depreciated, the amount that's left is 0.85% of the initial investment. So we take 0.85. All right. And then, yeah, that's pretty much it. 0.85 into 0.3. So we get this as 17850. This is the CCA in the second period. All right. Then similarly, we just keep calculating it, but then I'll do it for the next one too. So this was for D3. D4, what we do is you take the CCA rate, 0.3. But this time, okay, to calculate the UCC, right? So what happened in this third period is it got depreciated by 15%, okay? It got depreciated by 15% in the first period, but then in the second period, it got depreciated by 30%. So we take the initial book value of the first period, that is 0.85. Since it got depreciated by 30%, what's left is 70%. So we take it as 0.70. And then you do this and you get the CCA for the fourth period. You guys can stop me if you have any doubts. .85 into 0.7. So you get 12495. 12495. Okay, this is pretty tedious, but then you just keep doing it. So what happens in the next one though is that each year going forward, it gets depreciated by 30%, right? So in this one, it's just 0.370K into 0.85 into 0.7, and then again a 0.7, so 0.7 square. And then each period going forward, it just gets multiplied by another 0.7. So you get 0.7 cube in the next one, 0.7 raised to the power 4 in the next one. So I'll just use what I already did. That way I wouldn't have to fill all this. Okay, yeah, this is for the next one. Here we are. We calculated till 17,850, I guess. And then if you do the next one, suppose you do this one, you get 0.3 into 70,000, 0.85 into 0.7 square. 1 second. .3 into 70,000 into 0.5 to 0.7 into 0.7. Yeah, so no, wait, what did I do? 0.3 into 70,000. 0.85 into 0.7 to 0.7. Getting it at right, you're getting 8,746.5. So since we use the whole number approach, you just 8747 as for the third CCA in the fifth period. Okay. So similarly, using this same formula, you just keep filling this up, right? So this one would be 0.3 into 70K into 0.85 into 0.7 cube. And similarly, you just keep multiplying it by 0.7 each period going forward. So this you multiply by 0, you get this. Then you keep multiplying by 0.7, and you keep getting that, right? Do you guys get what I'm trying to say? Wait, yet.
Yeah. So like,
Yeah,
Okay.
makes sense.
Yeah. You were
There's-
saying?
Yeah, go ahead, Robert.
I think it was Erwin asking, right? What were you saying?
Oh, I said it makes sense. Yeah,
Yeah?
it makes
Yeah,
sense.
Isa, what were you saying?
I
Oh,
would say there's a formula way for doing it if you're just trying to find one thing. Do you remember what that was? So like we don't
Oh,
have to do the
you
whole
mean
table.
right? Okay, yeah. So if you want to find it for one, you just use a formula. Wait,
Do you remember what the formula was, or because I
1 second. So
saw it
the
in the slide.
dn would be the CCA rate into the bn minus 1, the UCC n minus 1. So the UCC n minus 1 is just equals to CCA into u into p into first one is going to be different. Okay. Wait, I think I have the slide open. 1 second. Right here. Okay. Yeah, this is the formula for getting those values, and this one is 1 minus d by 2. It's the one that we did for the first period, where we're depreciating by 15%, and then each period going forward, you just depreciate it by normal CCA rate given. Yeah, this is the formula that you use. Right? So what I did is I just wrote down the whole table, because that way you just get the answer to everything. And the reason that it's simpler in my point of view is because just keep multiplying 0.7 for each period going forward. So you just keep so suppose I got 8746.5. I multiply 0.7 and I get the 6122.5. This way you calculate this column. Now for the UCC of the equipment, right? So the UCC is calculated as the UCC1, it's calculated as P into the 0.85, because in the first period it was depreciated by 15%. So what's left is 85%, and you do that. In the second one, it's P into 0.85 from the first period, and then 0.7 because it was depreciated by 30% in the second period. So, and then each period going forward, what you just do is into 0.85 into 0.7 raised to the power n minus 1. Do n minus 1 because in the first period we were not doing at 0.7, we were doing 0.85. In each period going forward, we use 0.7. So if it was UCC2, it would be 0.7 raised to the power 2 minus 1. Come on. So this is the formula if you would just like to find it out for each one. But yeah, what I did was I just calculated the first one and then kept multiplying 0.7. The UCC, the way I found this 59,500 was, so UCC1 equals 70 into 0.85, get a 59,500. And then UCC2, you take the 59,500 and you multiply that by 0.7. Because what's left in the second one is 0.7 of 70% of the first one. So this way you get 9,500 into 0.7, 31,050. So you just keep multiplying 0.7, or you can just use that formula to calculate the U in any of them. So for U6, suppose, it would just be, the reason I find this formula, I find this table better, is because now that I have this, I could just look it up. So for n equals to 6, it was 6,123. And I think that's the answer. Just recheck. No, they asked you 6. Never mind. So it's here. 6th period. The undepreciated cost is 14,286. Here. Okay. So, second. Right. So yeah, if you want, I'll just solve it using the formula. 70k into 0.85 into 0.7 raised to the power 5 equals to yeah, what was this? This is 6th period. 70 into 0.85 into 0.7 raised to the power 6. So yeah, you keep multiplying this by 0.7 and then you get this 14,286 of the 6th period. Then similarly for the U8, what I did was U8 right here, 7,000. You multiply this 14,286 by 0.7 square. So 14,286 into 0.7 square. So you get 7,014, but then you just leave the point because you don't do that in this chapter 8 and 14. You get 7,000. Right. So this is how I calculated this all. Yeah, then for the overall, we do is said the overall is require the straight line approach, and it is 12,000. What we do is the overall is 12,000. The salvage value for the overall is 0 right here. 12,000 minus 0 divided by we use the overall in n equals to 7, right? The total number of years for the whole thing is 12. So if you keep counting 7, 8, 9, 10, 11, 12, you get that the overhaul is used for 6 periods. So you do this and you find that the D for the overhaul is going to be 2,000, right? Okay. So this is the CCA for the overhaul. But in the first period, we know we use the 50% rule. So 50% of 2,000, and we're just going to be using 1,000. The first period that the overhaul is put in. And then each period going forward, we just use 2,000 because it's a straight line approach. Yeah, what do you say?
Sorry, I forgot my mic.
Okay, no problem. Does anyone have any questions for this? No? Okay,
Yeah, it
all
seems
right.
pretty
So
straightforward.
yeah. I didn't get what you said.
Okay, can you hear me?
Okay, all right. So you find the overhaul for the you find the CCA for the overhaul and the CCA for the equipment in separate columns, and then so then we're left with the UCC for the overhaul. So to find this out, what we do is we know that in the first the overhaul has 20%, I think. Oh, my bad. The overhaul in each period is being depreciated by 2,000, but in the first period it's going to be depreciated by 1,000, applying the 50% rule. So the initial investment for the overhaul is 12,000 minus 1,000, and you get 11,000 right here. And then each period going forward, it's being depreciated by $2,000. So you just keep subtracting. Oh my god! Just keep subtracting 2,000, and you get 9,000, 7,000, 5,000, 3,000, 1,000. That's all you do for the UCC of the overall. Once you get this table, it's pretty simple after that. So suppose in this question they said find CCA 7. So we can just take it from the table. And so in this, we need to find the total CCA because in the 7th period, we have both the equipment and the overhaul. So the total CCA would be 5285 and 7. 5286. So that would be the total CCA in the 7th period. Let me just check this. Yeah, right here, 5286. Okay, then after this, we need to find the CCA for the 10th period. And here it's between 69.99 and 2000, so that would be 34693470. And that's pretty much what you do. You just add up both the CCAs and you get the CCA for the 10th period. Now they asked us to find the disposal tax effect, right? So the disposal tax effect is calculated on the basis of the final UCC of the whole project. So in this, the final UCC was right here. Adding these both, you get 2680.7 or 2681. So the formula for the disposal tax effect is the U final minus S multiplied by the tax rate that they gave us, which is given as T. So here it's 2681 minus the salvage value is 3000 and multiplied by 0.25. So what you get is 2681 minus 3000 to 0.25. You get minus 79.75. Right, so minus $80. So what this means is the project has been depreciated more than it should have been, and so as a result, since the UN is lesser than S, it's been depreciated more, and the company has paid lesser taxes that way. Because the thing about taxes is that they're calculated on how much depreciation your assets have faced. So if it has been depreciated more than it should have, you're paying lesser taxes that way. So now the company has to give this extra $80 to the CRA, the Canadian Revenue Agency, if I'm not wrong. That's how you calculate this disposal tax effect. Anyone has any questions on this before we go forward? Am I still this? Yeah. Okay, all right. Okay. Fine. So we were here. Right, so for the next one, yeah, so they're asking, this is second problem. Consider an equipment purchase of $100,000 today in 2018, and it's made available for use in its third year. Right, so the CCA starts only when it's available for use. In this case, in the third year, and then the equipment is expected to be operational until mid 2029, and in 2023, it'll require an overhaul costing 20,000. So in this case, what they did is the CCA rate for the overhaul and the equipment is different. So we need to calculate it based on that rate. And the 50% rule applies to both. Okay. So here what I did is the equals to 100,000. And what we need to keep in mind while doing these type of questions is that if they give us the year, you're supposed to like, now, if you just think about it, you might think that the equipment lasts for 9 years from 2020 to 2029. The thing is, it starts from 2020. So the 2020 year is also counted. If you keep counting it on your fingers or something, you find that its estimated life is for 10 years and not 9 years. So that's why I wrote here. The life is for 10 years. And okay, so it starts in its third year, right? And the overhaul is in 2023, which is the fourth year, 2020, 2021, 2022, and 2023 in the fourth year. Okay, so what we do in this is CCA of the equipment, calculate this. Okay. So to calculate the CCA, what we do is 100,000. And the equipment has a CCA rate of 30%, but then it's the first period. So we take 0.15, which is half of 30%, following the 50% rule. And you get $15,000. The first one. Then the CCA 2 is going to be dependent on the previous UCC. So, okay, let's calculate the UCC. UCC 1 is going to be how much of the value is still left. If it's depreciated 15%, 85% of it is still left. So 100,000 into 0.85 gives 85,000. That is the UCC 1 right here. Now what you do for CCA 2 is you just take the previous UCC and you subject it to the CCA rate, which is 3%, that is 0.3 into 85,000. Okay, so that is 0.3 into 85,000. 25,500. That's pretty much it, yeah. And then again, the UCC second year. This time, the equipment has been depreciated by 30%. What we would do is 100,000 or UCC 1 into 0.3. UCC 1 is 85,000. Sorry, my bad. It's been depreciated by 30%, so what's left is 70%, 0.7. So 85,000 into 0.7, you get 59,500. That's the UCC 2. That's the amount left. That's the value of the equipment after 2 years. 2 years of depreciation. Okay. Then yeah, I'll just do this for one more period because okay, CCA 3. This time 9,500, and it's again undergoing 30% depreciation. So yeah, the formula for this would be the P initial to what is the depreciation in the first period. That would be 1 minus D by 2, taking in the 50% rule. And then for each period going forward, it's going to be 1 minus D. To the power n minus 2, because in the first period, it would be 1 minus D by 2, and then it's going to be 1 minus D. So yeah, you just calculate this, and it's going to be 17,850. Similarly, you can calculate the UCC for the third year, and the formula for the would be P into 0.85, which is, wait a minute, did I mess something up here?
No, I think you're good.
Yeah, it's good. Okay. So I did miss
Oh wait,
something.
yeah, you did the D.
Yeah, the DD. All right. So the thing is, this part gives you the 59,500 because this is the previous UCC value. So this is the UCC2, and it's being multiplied by the D. That is the 0.3. Thus, you get the CCA3. So for UCC3, what you do is, again, P into 0.85 in the first period, and then 0.3, and then 0.3. Instead of that, you can just square it, because in the first period, it was 0.85, and then in the following two periods, it's 0.3. 0.3 square. And what you get when you do this is 1,650. I'll just do it. 1,000.
And squared.
Right, my bad. Yeah,
Okay,
0.7 square. Yeah, 0.85, 0.7 square. Yeah, you get 41,650. That is the undepreciated value after the third period, right here. Okay, so yeah, this might look a bit tedious doing this for the whole thing, and I guess we've got like 3 hours in the paper, so it should be enough time. Anyway, what is the total UCC for 2024? Okay, so now while they give us the year 2024, we should first convert it into which period would it be. So UC 2020 is the third year, right? So after 2020, there are still 5 years for 2024. So 5 periods going forward. 1, 2, 3, 4, 5. It's this one. In the 7th period. Okay, let me check if I'm right. What are they asking? Okay, they're asking the total UCC. So to calculate the total UCC for this period, you add this with this. Okay, let me. UCC 7th. I didn't do it here. I'll just check what they did. UCC 2024. Yep. Yeah, it's right. So if you add these two, this one and this one, both are in the 7th period, you get 20,408. I think he took the 0.5 plus 14,100. So you get the 34,808. Okay. You get that value for UCC 2024. Next, you're asking us the CCA for 2026. Again, we take it year by year. So 2026 is the 7th year from 2020. So 1, 2, 3, 4, 5, 6, 7. I think it's going to be the 9th period this time. So the CCA, calculate the total CCA. You just add this up. This one, and this one. CCA of the overhaul and the CCA of the equipment. You add both of them up. So you get 4286 plus 304. 6590. Is that right? 6589. Probably mess up the rounding off somewhere. So I'm getting it as 6. If you add these both up, I'm getting it as 6590. Yeah, I think he usually allows around $50 range, so that should be pretty fine. Okay. Right, we just got this one more question, and then you guys can ask me if you have any doubts. All right. So now you have to find the resale value expected to fall by 20% annually. The date of purchase, and this is something really important. The marginal tax rate is 40%. Find the disposal tax effect. Okay, so the disposal tax effect was the UN, that the UCC of the final period, minus the salvage value in the final period, and multiplied by the tax rate, that is 3%. Okay. So now the final UCC we got was this plus this 430 plus 4718. Which you get as 8148. All right. So this is the final UCC 8148. And what did they say the salvage value? Okay. So to find out the salvage value, they said the salvage value fell by 20% annually from the date of purchase. So the initial rate is 100,000. Okay. Is that right? Yeah. I'm missing a zero. Right. So 100,000. It's falling by 20%. What's remaining is the 80%. So each year, 80% is remaining of the salvage value. Okay. So now for how many years? The thing is, what I thought initially, and the mistake I made initially was, I thought since it's 10 periods from 3 to 12, I thought it's supposed to be 0.8 raised to the power 10. But they said from the date of purchase. The date of purchase was here. They said the equipment will be available for use in its second year.
I think that's the wrong question.
Right, yeah, sorry, my bad. In the third year. So we're missing 2 years before that when we purchased it in 2018. Instead of 10 periods, it's going to be 12 periods. So the final value for the salvage value is going to be 100,000 into 0.8 raised to the power 12. So you get this as 6,871.9, or you can just write 6872. And now in this case, the salvage value is lesser than the UCC, which means that the equipment has been depreciated lesser than it was supposed to be. In this case, the company paid more taxes. It wasn't depreciated completely. The company paid more taxes than they were supposed to. So now we find the DTE equals to 8148 minus 6872 into the T, or the marginal tax rate, is 40%, 0.4 equals to 8148 minus 6872 to 0.4. 210.4. So this is the amount that the CRA is going to give back to the company, make up for the extra taxes that they paid. That is the disposal tax effect. All right. Wait. Yeah, so I got 510.4. They got 511, probably because of some rounding errors. Yeah, that's pretty much how you do this one. You guys have any doubts in any of these? That's the end of chapter 8. No?
This stuff's pretty important for 14, right?
Right, yeah. This is basically like the fundamentals that you use in 14.
Alright,
We got to calculate the DTE and all this again.
yeah, makes sense. Alright. Guess there's no
Okay,
other
cool.
questions.
And let's just go to chapter 14.
But yeah, there was something, I don't know if Gerbert said it in your class, but he said that for chapter 8, when you do the UCC and the CA, the powers of everything should match up to the year that you're doing. I don't know
Okay,
if
let me
you
just
said
go.
that for your class, but like, let's say for one of them that you did, like let's say U3, the powers of 0, okay, just once you get to it. Alright, yeah, so like, oh wait, can you go down to your calculation of it? Because it'll make more sense.
Down?
Like,
Are you talking? Okay, this one.
Yeah, there you go. Okay, so like that,
Yeah.
you're doing UCC of 3, and your power of 0.8 is 1, and then your power of 0.7 is 2. So like, that's what he told us, at least for your powers, they should match up to whatever year you're doing. So if you have to like 6,
Right. Yeah. That makes sense. Yeah. So this is 1, and you add both of these, you get 3.
Yeah, exactly.
Yeah, that makes sense.
So it's easier for like stuff like U5 or U11 or whatever. You know that the first one is
Okay.
just your depreciated like 50% rule, and then the rest is just the powered.
If I go to the formula here, right here, so n would be, this would be 1 minus d to the d by 2 to the power of 1. Then you add 1 and n minus 1, so you get n.
Yeah,
Yeah.
exactly. Like that's
Yeah,
how
that's
I.
another good way to figure it out.
Yeah, that's how I think of it.
Yeah, correct. I think, yeah, it might be easier to use the formula directly, but I just find this easier because now, like, after I've done this table, I can get all the answers in, like, just by adding it up.
Yeah. I mean, if he asked for multiple, then yeah, this would be better. But I feel like he might
Yeah.
just ask like sometimes for one specific.
Right. Yeah. But then, yeah, in chapter 14, he asks for multiple questions. Yeah. correct.
Oh, that's true. Yeah. So for 14, that's pretty good. But yeah.
All right.
I have a quick question. How do you find the UCC for disposal tax effect again?
Right. So for the disposal tax effect, the UCC is going to be the final UCC of the entire project. So in this case, the final UCC of the equipment was 3430, and the final UCC of the overhaul was 4718. You add these both up, you get 8148, which is the UCC that we used.
All right, thank you.
Okay, no problem. Any other questions? Okay, all right. So I'll just go ahead. Chapter 14 then. Is this chapter 14? Yes, no, it's questions. Great. Okay. Do you guys want to take a break or are we good to go?
Like 3 hours, but if anyone else wants to speak it.
Yeah, same. Anyone else?
You're good.
Alright, majority vote 2 people. GG.
What did they say? Did anyone else say anything on chat or something?
Let me check that. Nope, nothing. Alright, well, yes.
Okay, I guess I'll just go ahead.
Maybe like 6 o'clock ask again and see if. Yeah.
Right. Yeah. Okay. So chapter 14 basically talks about inflation and like it adds various different things to it. But basically, I think there's going to be like one question with 5 or 6 different parts in chapter 14 because that's what Gurits told us. And you pretty much have to know. You're pretty much going to need to know how to do this table. And what he said for us is don't try to learn this table or anything because there's no way to learn the table. You need to know what you're doing in which column or rows. So the table is basically divided into 2 things. One is the income statement, one is the cash flow statement. First, you calculate the income statement. From that, you get the net income after deducting the taxes. And then you calculate the cash flow statement. Okay. So for the income statement, you need the revenues and the different expenses. So in some problems, I think in the problem he's going to ask us, it's going to have all of this. Operational and management costs, the debt interest, because I'll just do the second problem right away because that one has everything. Okay. So, and then debt interest, and what you do is first you calculate the revenues. How this works is for inflation, there's 2 things that we need. One is the constant dollars and one is the actual dollars. So the actual dollars already account for the inflation, whereas the constant dollars do not have the inflation in them. So what you do is if you have if you have, the constant dollars are given by A dash, whereas the actual dollars are given by A. So to get the actual dollars from the constant dollars, what you do is you take the A dash and you multiply that by, you inflate it. So what you do is 1 plus F raised to the power of whatever, whichever period you're moving it. So to the power of N. That's basically how you inflate or deflate anything. This is inflating, and deflating is basically the opposite, getting constant dollars from actual dollars. 1 plus F raised to the power minus N. That's just how you do it. Okay, this is deflating, and we'll need this later on in the table, right towards the end of the table. So what we do for the table is almost always they're going to give us the constant dollars for to the stuff. It's 30,000, 12,000, all of this is constant dollars. So we need to convert this to actual dollar costs. So to do this, okay, so let me just read the question. So Hartsfield company is considering purchasing a set of machine tools at a cost of 40,000. This is the fee. Okay. And the purchase is expected to generate increased sales of 30,000 per year. And this is the revenue. Okay, 30,000 per year in constant dollars. The revenue is going to be 30,000. It's A dash. Okay. Then operating costs of 12,000 per year. Again, this is constant dollars. Each of the next 3 years, additional profits will be taxed at a rate of 40%. That's the income tax rate here, 40%. And the asset falls into CCA class. Rate is 30%. This is to calculate the CCA. This is basically where we use the chapter 8. We'll use the chapter 8 again here to calculate the disposal tax effect. Okay. Then the asset falls, okay, this is done. And the 50% rule applies. So yeah, the 50% rule is basically every single question in our course. You just need to use that. The project has a 3-year life. And yeah, this, my bad. Most of the table that he has given us has 3 years. So I think he asked will have 3 years life. It's $5,000 salvage value. Okay. And yeah, the salvage value will come here later. This might be confusing right now of how I got 6,655, but I'll get to it later on. Assume the firm also requires someone unmuted again. Okay, I think it's good now. Also requires working capital of $4,000. So yeah, so the working capital is basically how he explained it to us is that suppose you go to a restaurant and the waiter there, he needs to carry a pouch to keep track of change, or in a grocery, if you go to a grocery, they keep a separate box to give you change. So that is the working capital that any company keeps. So that is like the day-to-day expense that might be completely expensed, or it might get left over. But that working capital, it doesn't give you any return on interest. So you cannot put that in a bank and get interest on that, on the working capital. So that is okay. The working capital is $1,000. Okay. Which will be recovered at the project's completion. So at the end of the project, again, you'll get those $4,000 back. It's a day-to-day expense. All right. And that the machine tools will be purchased 50% on debt. Okay. So the debt interest here is 50%. Okay. Oh, I mean, not the interest. What we're doing when they say 50% on debt is, since banks won't just give you the loan for the entire cost of your project. So since we need 40,000, instead of asking for a loan on the 40,000, we just asked for a $20,000 loan. So we take in 20,000. Where is it? Borrowed funds, $20,000. This one. Okay. All right. What next? The debt will be paid off in equal annual payments for the life of the project. So again, we use this chapter 3 stuff now. Basically using every single chapter in this. The interest rate on the debt was negotiated at 12% annually. The I for the debt is 12%. Okay. Yeah, we're going to need to calculate the interest in every period and the PP, principal payment of every period. Yeah. General inflation rate is 10%. So the inflation rate is given by the letter F. And there's a line on top of it, the general inflation rate, 10%. Okay, and affects everything that it normally affects. Okay, assume a MAR of 7%. MAR dash of 7%. So this can be applied to constant dollars only. It's important. You cannot. So at the end of this table, you're going to get the net cash flow in actual dollars, but you cannot apply that MAR to the actual dollars. You need to convert it. You need to deflate it back to the constant dollars and then use the MAR. Because this is the MAR dash. Or you can just convert the MAR dash to MAR. There's the formula for that. I'll just get to it. Okay. Remember to round up or down to whole dollar figures for every entry. Okay, all right. So, right, let's start with the revenue. So they said that the revenue is $30,000 per year. So n equals to 0, there would be no revenue, no expenses, because that's the beginning of our project, and that in the n equals to 0 column, all we're going to have is $40,000 of investment. That's all, and then the borrowed funds. Okay, so yeah, this bracket means that it is negative, and like when we just add this up, it's easier that way to differentiate. Okay, so now the revenue starts from n equals to 1. So in the first column, what we do to calculate the revenue is we know it's revenue in the first one equals to constant dollar revenue is 30,000. So now we need to convert this to actual dollars. Do that. Take 30,000 into 1 plus F. And F here is 30,000 into 1 plus the general inflation rate is 10%. So 1.1. Okay. You get 30,000 into 1.1, and it's just one period that we're going forward because it's n equals to 1. So you get 30,000 into 1.1. Let me just do that. You get 33,000. That is the revenue in actual dollars in the first period. Similarly, you can find the revenue for each of those periods. You just multiply the previous one. You multiply R1 by 1.1. Keep multiplying for each period, and you get the revenue for each period. 33,000 multiplied by 1.1, you get this. Multiplied by 1.1, you get this. So the easiest way to go through this table is to like start one row and completely fill the row, then go to the next rows. Instead of going column wise, instead of like completely filling the n equals to 1 column, take one row, fill the row, and move to the next one. So you get the 33,000, but yeah, I just said that, okay. Next, for the operational and management costs, they say the operating costs is $12,000 per year. So we need to inflate that because that is again constant dollars. So the operational in year 1 equals to 12,000 into 1.1. That's just basically it. So you get 12,000 into 1.1. Let me just confirm that. 13,200. And then again, you multiply this by 1.1, multiply this by 1.1, and you get the operating costs in each of the three periods. Now, to calculate the CCA, this is where we use the chapter 8 stuff. CCA at 30%. Okay. So CCA 1 equals to, we took the investment as 40,000. So $40,000 into, and yeah, one thing about the CCA is doesn't undergo inflation. You don't need to worry about converting it to actual dollars. Okay. So CCA 1 is 40,000 into 0.15 because the 50% rule applies. So the CCA rate is $30,000 right here. But then in the first period, it's going to be 40,000 to 0.15 because it's the 50% rule. You get 6,000. Is that what I got? Yep. Okay. Then the CCA for the second period equals to 3,000. Now, remembering the formula for the CCA, you take the UCC of the previous period and then you multiply the CCA rate with that, right? So here in the second period, the CCA rate is going to be 0.3 because that's the normal rate. And then the UCC of the first period was 40,000 into 0.85 because it was depreciated by 15%. So what was left was 85%. So you get 0.3 into 40,000 into 0.885. Okay, so that is 1,200. The CCA for the second period. Similarly, you get the CCA for the third period as 0.3 and into UCC 2 this time. So you get that as 0.3 into 3,000 into 0.85. This was the UCC 1 and then 0.7. This became the UCC 2. Calculate this and you get 700 and wait, is that wrong? No, 7,140. Okay, that's right. 7,140. This way you fill up the CCA. Okay. Does anyone have any doubts this far? We've done this much of the table till now.
Can you show UCC3 again?
Okay. Yeah, I'll just use this next table. That'll be okay. Yeah. So the CCA for 3. Yeah. So again, you use the same formula. So for CCA in the nth period, it is D into UCC n minus 1. So CCA 3 is going to be 0.3 because the CCA rate is 0.3 normally, and only in the first period it's going to be 0.15. So here it's going to be 0.3. UCC you get by the initial investment, 40,000. Much it got left in the first period, 0.85. And then in the second period, it got depreciated by 0.3, so what's left is 0.7. So you multiply this and you get 7140.
Yeah, makes
Okay,
sense. Thank you.
Okay. I'll start filling this table because then we can keep track of where we are. 33,000. 36,300. 39,930. Right. Then 13,200. 14,000. 20. 15,972. And yeah, we just calculated the CCA. 6,000. 10,200. And 7,140. Okay, 1 second. I'll just be right back in 1 second. Okay, I'm back. Okay, so yeah, so now let's calculate the debt interest because that's the next thing here. Will I skip that? Debt interest right here. What we need for the debt interest is we need the interest that's being interest in each period, basically. So we're taking a loan of 20,000. If I make the cash flow diagram for this, in period 0, you're taking 20,000. You're repaying that. Oh, it's the opposite way. 20,000. And then in each period, you're repaying. Okay. So we need to find out the annual cost, or is it called? I don't remember. But we need to find out the A. So the A is 20,000. A given B. Now we need, what is the interest rate? The interest rate on the debt was negotiated at 12%. 12% for 3 periods. Okay. So let's see if I can pull up the interest rates. Interest factor tables. Right, so we go to the 12%. Okay, this is 12%. So now we need to get AP 12% 3. AP 12% 3 is right here, 0.4163. So A equals to 20,000. It is 0.4163. So you just multiply this and you get 8326. Okay, that is the A value. Now we need to find the interest payment in each period and the principal payment. So that B0 is going to be 20,000. The interest in the first period is going to be 20,000 into the interest rate, which is 20,000 into 2%, which is 0.12. So you get in the first period, the interest payment is 20,000 into 0.12, 2,400, right? And there goes our first value in the payment, debt interest, 2,400. Oh my God, what's wrong with me? 520, 992. Okay, I hope the rest is legible. Is my screen still blurry or something?
On the factor
Anyone?
tables, but like your OneNote is decent.
Okay, cool. Yeah, the factor tables is really small. That might be the reason. Okay. Anyway, so we got the interest payment at the first period. So now what we do is we find the principal payment in the first period, and we get that as A minus I1.
Wait, so for
So-
interest, you're just doing it from the chapter 4 stuff, right? Where you take the principal
Right,
and you
yeah,
multiply.
yeah.
Okay.
Exactly. We're just using every single chapter in this.
Yeah, pretty much. Except 11, I guess, but yeah.
Yeah, except 11. Yeah, we use 5 and 6 also because we were going to be finding out IRR.
Yeah, that's true. Yeah, you can continue.
Sorry. So 8326 minus 2400. You get the principal payment as 8326 minus 2400 and 926. Then again, now balance after the first one is going to be balance 0 minus principal payment 1. It's a whole pretty long process to fill up the whole table. He said it might take around 20 to 25 minutes. So if you think that you're taking a lot of time, don't worry, because it is supposed to take a lot of time. Okay. So 20,000 minus 9926. 15,074. All right. So now the interest in the second period is going to be 14,074 into 0.12. Okay, 16,888.8. So I guess I'll just do 16,888.8. Then principal payment 2 is going to be A minus I2 is equals to, yeah, okay. Did I just get disconnected?
You're good. That was probably just someone leaving the stream.
Okay, cool.
Oh, and you stopped your stream. Oh, well, he actually did get disconnected. Feels bad. Okay, then. Guess I'll just stop recording there.